What's going on YouTube? In this video, we are going to explore buying stocks on margin. More specifically, I'm going to explain to you exactly what buying stocks on margin means, the things that you need to be aware of when you are buying stocks on margin. I'll also be showing you a real brokerage account that I have that does have a small margin balance on it. And more specifically, I'll be walking you through exactly how to tell when you are on margin, and most importantly, how to avoid buying stocks on margin if you do not want to. Let's get started. What is buying stocks on margin? Well, buying stocks on margin really means that you are borrowing money from the brokerage firm in order to purchase shares of stock that you would not otherwise have been able to. A good analogy is actually buying a house. When most people buy a house, they do not pay 100% in cash out of their pocket to pay for that house. Usually, they'll put down a small percentage, such as 20%, and the remainder of that balance they will borrow and pay that off in the form of a loan over time, which is called a mortgage. By doing this, they are able to purchase a $500,000 house while only having $100,000 saved up. So in this case, we could say that people buy houses on margin because they are able to purchase something that they actually cannot afford with the cash that they have in their pocket right now. In the world of stock trading and investing, you can do the same exact thing, but with stocks. When you buy stocks on margin, you are borrowing money from the brokerage firm in order to purchase more shares than you actually could afford on your own and with the cash out of your own pocket. And traders do this and investors do this because it is an opportunity to leverage their returns. In a regular margin account, you can get 2-to-1 leverage, meaning that you can buy twice the value in shares that you actually have in equity in that account yourself. So an example would be if I put $10,000 into a margin account, I can buy $20,000 worth of stock. So if I put $10,000 into a margin account and I buy $13,000 worth of Apple stock, I am actually borrowing $3,000 from the brokerage firm to buy the additional $3,000 in shares over the $10,000 that I put into the account initially. As soon as you buy shares that are worth more than your equity in the account, you are said to be on margin. And that means you are borrowing money from the brokerage firm to purchase shares of stock that you would not otherwise have been able to afford with the cash or equity in your account that you put in yourself. If you borrow money from the brokerage firm, you are going to pay interest payments on the amount that you've borrowed from the brokerage firm, and this is called margin interest. So in our example where I deposited $10,000 into the account and I purchased $13,000 worth of Apple stock, since I borrowed $3,000 from the brokerage firm, I will pay interest on the $3,000 that I have borrowed. The amount that you pay in interest is calculated on a daily basis, and typically your brokerage firm will take the sum of your interest payments over a certain period, typically 30 days or 1 month, and then at the end of that payment period or interest period, they will debit your brokerage account, meaning they will literally withdraw money from your brokerage account equal to the interest that you have to pay based on the amount of margin or the amount of money that you borrowed from the brokerage firm over that period of time. So in my example where I deposited $10,000 into a margin account and I bought $13,000 worth of Apple stock, I am borrowing $3,000 from the brokerage firm, meaning that my margin balance or my negative cash balance, which we'll talk about in a minute, is $3,000. Now, if the brokerage firm charges 7.5% interest, that means on an annual basis, if I held this $3,000 margin balance for a full year, I would pay 7.5% in interest on that margin balance of $3,000. So if we take $3,000 multiplied by 7.5%, we get an annual interest payment that I would owe of $225. But this is the annual rate. To get the daily margin interest payment that I owe, we have to take the annual rate, which we've just calculated to be $225, and divide it by 360. If you're wondering why 360 and not 365, well, it's a weird thing in the finance industry where we use 360 as opposed to 365 when using the number of days in a year. So if you've ever calculated a bond interest payment, it's the same thing. They use 360 days in a year as opposed to 365 days in a year. So based on my $225 annual interest payment of borrowing $3,000 at 7.5%, If we divide 225 by 360, we get a daily interest payment of 62.5 cents. Based on a 62.5 cent interest payment per day, if I held this margin balance for 30 days, assuming that the margin balance was $3,000 every single day, and I held it for a 30-day period, I would pay $18.75 in interest for borrowing $3,000 from the brokerage firm at a 7.5% annual interest rate for 30 days. So let's hop over to my brokerage account and we'll continue on from there. All right, I just opened up Tastyworks, and now we're looking at my brokerage account that I just opened and have a few share positions and option positions in. The first thing I want to do is look at my balances, and I can do that by clicking on this blue BAL button, which will bring up my balances. So if we click on BAL, we can see that it gives me my cash balance, my maintenance excess, my long equity value, long equity derivatives value, and so on. So my net liquidation value, or net lick, is $5,063. So this basically means if I close all the positions in my account and pay back the money that I borrowed from the brokerage firm, if any, what will I be left with? So in this case, that's $5,063. So I'm going to click on this balance again, and we can see that it says my cash balance is negative $822. Where does that come from? Well, first, let's keep in mind that this account, the value that I have in it, or my equity, meaning if I closed everything, paid back the brokerage firm the money that I owe, I'm left with $5,063. So it says my long equity value is $3,997, and that is the value of the shares of stock that I own. The long equity derivatives portion is actually options that I've purchased. So that value is $1,888. So if we take 3,997 plus 1888, we get $5,885. And if I subtract my equity in the account from this value, 5063, we get $822. So that is exactly how the brokerage firm is telling me my negative cash balance, or my cash balance is negative 822, is because I have purchased securities in my portfolio worth $5,885. But to do that, I had to actually borrow some money from the brokerage firm, and that means that I have borrowed $822, therefore purchasing securities in my account more than my initial equity. So if we add up the share positions, that'll be 3,997, and if we add up the option position, that's 1888. That gives us $5,885. So I'm going to show you really quickly the capital requirement for these share positions. If we look at this Tesla position, this is a share position of 2 shares. So the net liquidation value is $1,638, meaning if I sold both Tesla shares for $819.42, I would receive $1,638.84 in proceeds. So this is the value of the share position. If I click on capital requirement up here in the top right, or cap rec, we can see that under Tesla, it says my margin requirement, or initial requirement, is $819.42. So essentially that is 1 share's worth of value. And that's basically telling me that the brokerage firm only made me set aside 50% of the share's value to purchase $1,638 worth of shares. And that's because I have a margin account, and you only have to put aside 50% of the value, therefore giving you 2-to-1 leverage if you want it. So based on my negative cash balance of $822, how much would I pay in interest over a 30-day period? Well, Tastyworks charges 8% on any money borrowed below $25,000. So if we take $822, which is how much money I've currently borrowed, or my negative cash balance, and we multiply by 8%, we get an annual margin interest payment of $65.76. To get the daily rate, we divide by 360 as described earlier, and that comes out to 18 cents per day. So if I hold this for 30 days, my margin interest payment would be $5.48. So I am not worried at all about the margin interest payments on this small margin balance. The reason I did it is because I will be making a deposit soon, and I did not see a problem with using a little bit of the margin. The last thing we need to talk about is how do you keep your account in a non-margin situation? And that means, how do you keep it with a positive cash value? Well, all you have to do is just make sure that the value of the securities that you're buying do not exceed your equity in the account. So if you put $5,000 into a margin account, you just have to make sure, if you are buying stocks or you are buying options, you need to make sure the total value of those securities does not exceed $5,000. But you don't have to necessarily calculate that yourself. You can just look at your cash balance, and as long as your cash balance is positive, you are not on margin and you are completely fine. So you will not pay any margin interest. You're not leveraged whatsoever. I hope that demonstration and walkthrough was helpful for you, and that you are more comfortable with understanding how buying stocks on margin works and how to avoid it if you do not want to buy stocks on margin. Personally, most of the time I do not want to have a margin balance in my account, but as I mentioned, I'm going to be making another deposit very soon, and because of that, I'm not worried with my $800 margin balance as of now, as when I make my next deposit, I will have a positive cash balance and no longer be margined. The last thing I want to discuss before closing out this video is maintenance margin. When you buy stocks on margin, your initial margin requirement is 50% of the value of the share position, meaning that to buy the shares, you have to put up 50% of the value of the shares. So if I have $10,000 in a margin account in cash, I can buy $20,000 worth of stock because I only have to put up 50% of the value of the shares, which is called my initial margin requirement. But there is a maintenance margin requirement, which is how much equity you have to remain above in your account before you get a margin call, which means you have to liquidate your position, meaning you have to sell your stock position to pay back the brokerage firm the money that they've lent you, or you have to deposit more money into the account to bring your equity above the maintenance margin, which we'll look at in just a second. Typically, the maintenance margin will be 25% of the value of the share position that you are entering. Going back to my $10,000 deposit example, if I put $10,000 into a margin account and I buy $20,000 worth of stock, my initial margin requirement is 50% of the value of the shares, which is $20,000 divided by 2, which is $10,000. But the maintenance requirement, or the maintenance margin, is 25% of the value of the shares, which is $20,000 times 25%, giving us $5,000 in maintenance margin. If my equity in the account falls below the maintenance margin requirement, then I will have a negative maintenance excess, meaning that I am not meeting the margin requirements to continue holding this position, and therefore I will receive a margin call from my brokerage firm, and they will say, you have to close the share position, or you need to put money into your account to meet that margin requirement. And obviously that's not a scenario that you want to be in. On the Tastyworks website, which is the brokerage firm that I trade with, they have a formula for the maintenance excess, and that is your cash balance plus the value of the stock position that you are holding minus the maintenance margin, which, as we discovered earlier, is 25% of the value of the stock position that you are holding. So in the example where I put $10,000 into the margin account, I bought $20,000 worth of stock, I have a negative $10,000 cash balance since I borrowed $10,000 from the brokerage firm to buy shares of stock. So my cash balance is negative $10,000, but I own $20,000 worth of stock. So if we take negative $10,000 plus my stock position's value of $20,000, we get a positive $10,000. If we take the value of the stock position, which is $20,000, and multiply it by the maintenance margin, which is 25%, we get $5,000. So my negative cash balance of $10,000 plus the $20,000 share position's value minus the $5,000 maintenance margin gives me a maintenance excess of $5,000. If your maintenance excess is positive, you are in just fine shape and you don't have to do anything because you are meeting the margin requirement to continue holding the position. But let's say the share position's value falls to $15,000. My negative cash balance is still $10,000 since I still borrowed $10,000 from the brokerage firm, but now the share position's value is $15,000. The maintenance requirement for that $15,000 share position would be $15,000 times 25%, which would give us $37.50. Going back to the maintenance excess calculation, if I take my negative cash balance of negative $10,000 plus the share positions value of $15,000 minus the maintenance requirement of $37.50, then we get a maintenance excess of $12.50, so $1,250. My maintenance excess when I entered the share position was $5,000, but now the share position's value has fallen to $15,000, and my maintenance excess is only positive $1,250. So my maintenance excess is getting closer to zero, and the closer to zero the maintenance excess gets, the closer I am to a margin call. If my maintenance excess goes negative, that means I no longer have the appropriate amount of money in my account or equity in my account to hold that position. An example would be if the share position's value falls to $10,000, let's calculate the maintenance excess. My cash balance is still negative $10,000 since I still borrowed $10,000 initially to buy $20,000 worth of stock when I only had $10,000 in my account. So my negative cash balance of $10,000 plus the stock position's value of $10,000 brings us to $0, but we still have to subtract the maintenance margin, which is 25% of the stock position's value. And since the stock position's value is $10,000, that means we subtract $2,500 from zero, giving us a maintenance excess of negative $2,500. In this scenario, I need to deposit $2,500 or more into the account to meet the margin requirement to continue holding the stock position. Otherwise, I need to close the share position so that I can pay back the money that was borrowed from the brokerage firm. But if we do the math, I put $10,000 into this account and I borrowed $10,000 from the brokerage firm to buy a total stock position worth $20,000. But now the share position is only worth $10,000. So I bought $20,000 worth of stock, and now it is only worth $10,000, which means the loss on that position is $10,000, and that's how much money I initially put into the account. So as we can see here, if you have 2-to-1 leverage, it takes a 50% decline in the securities in your portfolio to completely wipe out everything that you put in. If you had 3-to-1 leverage, you would need a 33% decline in the securities to completely wipe you out. So the higher your leverage is, or the more money that you're borrowing to purchase securities, the lower the percentage decline needs to be to completely wipe you out. And obviously, as I mentioned earlier, margin can work for you, but it can also work against you, which is why buying stocks on margin is a very dangerous maneuver. Personally, I would not use buying stocks on margin as a regular strategy that you implement. If you do use it, I would use it in a very short-term manner, meaning that you want to gain leverage to short-term stock price movements, but you're not actually buying stocks on margin and fully leveraging your account to hold for a multi-month period, because not only will you lose a lot of money if the stock price goes down, but you will also be paying interest on that margin. And if the share price is falling and you are also paying money in the form of margin interest payments, that is not a favorable investment scenario. So just as a 30-second recap, buying stocks on margin means that you are borrowing money from the brokerage firm to buy shares of stock that you could not otherwise afford yourself. By doing so, you put your account into a leveraged scenario where if you are 2-to-1 leveraged, a 10% increase in the stock price will give you a 20% overall account return, but if the stock price goes down by 10%, you will lose 20%. Also, and more importantly, if you are 2-to-1 leveraged, if the stock price goes down by 50%, you will be completely wiped out, and the loss on that position will be equal to the amount that you had in that account, or the equity that you had in that account. And lastly, if you want to avoid buying stocks on margin because you want to avoid all of the things or all the downsides that I've discussed in this video, all you have to do is make sure that you are keeping a positive cash balance. And to do that, you just have to make sure that you are only buying stocks equal to or less than your equity in the account. So if you put $10,000 into a brokerage account, only purchase up to $10,000 in shares of stock, and you will be completely fine. That's going to do it for this video, everybody. I really hope you enjoyed it. I know this was kind of a longer one and I rambled on a lot, but I wanted to provide as much detail as possible so that you could understand the ins and outs of buying stocks on margin how it works, and more importantly, how to avoid it if you do not want to implement this strategy. Because as I said earlier, if you do have a margin account, which is very, very common, there's not a button that you can press to say, I do not want to buy these shares on margin. You are going to only have to put up 50% of the share values that you're purchasing, and therefore you could accidentally put yourself into a negative cash balance situation. So I wanted to make this video and provide as much detail as possible so that you could avoid that scenario and be a more informed investor. My name is Chris Butler, and I will see you in the next video.